Assalamu alaikum. Welcome to my channel. So today's standard is IFRS 13 fair value measurement. Okay, and this is one of the standard which is used in conjunction with other standards as well. For example, IFRS 16 leases, IFRS 2 share-based payments. Then we have IS 16, IFRS 3 business combinations and financial instruments, right? Intangible assets, tangible assets. Not all these standards, but most of the standards requires IFRS 13's knowledge. Okay, so let us start. And this standard will come, right? There is no skip. 100% IFRS 13 will come. There is no doubt about it. 100%, there is no doubt. Usually I give a percentage, 90%, 80%, but IFRS 13 100%, because one or the other way you will get it, either through IS 16, either through IFRS 3, either through financial instruments, either through tangible intangible assets, IS, which is IS 38, either through investment property, which is IS 40. So either through one of the standards fair value measurement you will be asked, no doubt. So let us go to the introduction. Okay. So the reason why IFRS 13, you might be some might be asked, then why there's a separate standard for fair value measurement? If it is with other standard, then why not it is spread across the other standards? The reason why is, no matter whatever it is, whatever standard you're using, there are some, the fair value measurement is same for all the standards. That's why it is into a single standard. Okay, so that everyone, whoever needs to value something using fair value measurement, they know there is only one single standard, which makes your work easier. Think about from the point of the one who preparing financial statements, accountant, right? For them, how hard it becomes when they have to go through several standards, fair value when they have to value something using fair value measurement. But IFRS 13 one standard is only there, so we know that whenever fair value measurement comes up, no matter under any standard, we have to use IFRS 13, one standard only. Okay, this makes your work easier. Okay, and many accounting standards, it requires or it allows. Sometimes definitely it's fair value measurement. There is no choice. Some standards have a choice. They give you a choice whether cost or fair value. Okay, for example, from your earlier studies, also from your financial reporting, you might know that IS 16 and IFRS 3. IS 16 allows entity to measure property, plant, and equipment at fair value. It allows. Allows means what? Allows means there's a it's more flexible. Allows means it's an option they're giving you. You can measure at fair value or cost or revaluation model or fair value, right? IFRS 3, it requires, it does not give you the option. It says you must use fair value when you acquire a subsidiary. When you buy an associate, it must be valued at fair value, right? Also, the net assets, identifiable net assets of the subsidiary, these are to be measured at fair value at the acquisition date. Okay. Next, we have the scope. Remember two things. IFRS 13 does not apply to IFRS 2 and IFRS 16. Why? Because we have fair value measurement in IFRS 2 as well as IFRS 16. Then why not IFRS 13 is applied to this thing? Because the way fair value is measured in IFRS 16 and IFRS 2 are different compared to this IFRS 13 fair value measurement. Okay, it does not come in the scope of this standard IFRS 13. Therefore, when they're talking or mentioning fair value for your share-based payment, IFRS 2, or leases IFRS 16, do not use IFRS 13 there. You are not supposed to use it because IFRS 13 does not apply to these two standards. It's not in SBR, it's not only important to know which standard applies for which one, you also need to know which standard is not applicable to which standard. For example, what is the scope of the standard? Sometimes you cannot use the standard everywhere. You need to know where, in what situations or what circumstances you cannot use a certain standard. So that restriction you need to know. Okay. Next, we have the definition of the fair value. So what is the definition of the fair value? Memorize this definition because this definition you will need it in your answer. Okay. It is a price that would be, it is in bold. The price that would be received to sell an asset or pay to transfer liability in an orderly transaction between market participants at the measurement date. What does it mean? Whenever you have to sell an asset or you have to pay a liability, pay a debt, okay, the price that is in the open market, okay, that means it's not a price unique to you. Everyone else is paying the same price for that asset when you sell that asset or transfer or paying to transfer a liability, okay. There is a proper market is there where buyer seller meet orderly transaction. It is not hidden or not relative to relative, not something hidden where the prices are much less than the market price. No, okay. At that date, at that measurement date, that is known as fair value. The price which is available to the open market, everyone is paying that price only, not only you. Market participants are knowledgeable third parties. When pricing an asset or a liability, they would take into account, okay. See, market participants, they are knowledgeable third parties, okay. So when they price an asset or a liability, they need to take into account certain things. Three things: condition, location, restrictions on use. They just cannot put fair value on anything, okay? They need to look at the condition of that asset or liability. They need to see the location of that fair value of that asset or liability. They need to see the restrictions on use. Can you use it? Is it ready to be used? Or are there some restrictions? It should be assumed that assumed, okay? Whenever they give you the assumption, there is no doubt, okay? You always go by that assumption only. Don't change the assumption. That market participants are not forced into transactions. They are not suffering from cash flow shortages, okay? In reality, it's not like that. There are cash flow shortages, okay. Therefore we cannot sometimes go for the transactions which we want to go. We have, okay, or we might be forced into the transactions. For example, we need cash. Due to that cash, we might have to sell something. So we don't want to sell something, but we had to sell something because we had cash flow shortages. It's like we are forced to sell, okay. In reality, that's the situation, right? But for this standard, we are assuming it's not like that. Market participants are free. They are not forced into transactions, okay. IFRS 13 knows that there are various approaches to determining the fair value of an asset or liability. This is very important. Wait, I'm sorry. There are three approaches how you can determine fair value. One is known as market approach, cost approach, income approach. Market approach, valuation based on recent sales price. You see what is the recent sales price in the market. It's most available. So it's readily available. You can get it. Cost approach, you see what is the replacement cost. If I have to replace this asset of mine today, what is the cost? So you base on that, you value the fair value. Next is income approach, based on the financial forecast. You see the cash flow statements and all, you forecast, you find the present value of the cash flow statements, okay. So that is a based on the financial forecast. But you have to remember that whatever out of this three approach you take, aim is always the same, okay. What is the aim? You need to estimate a fair value, the price, okay. Next, the price. Sometimes you might be asked detail on IFRS 13. Sometimes fair value comes because on the others, in other standards, you need the fair value. You need to define fair value or you need to measure fair value. That's why you need the support of IFRS 13. But sometimes IFRS 13 as a standalone question, it will come. For example, in theory, you might have to explain this theory in IFRS 13. Then you need to learn this theory. Okay, what is the price? Fair value is a market-based measurement. You need to know this. Note that it not one that is entity specific. It does not change from entity to entity. Entity does not decide that okay, in my organization this is the fair value, in my organization there is the fair value. No, it's market-based approach. For everyone is the same. Market decides it. You should know it. Okay, the fair value. As such, when determining the price at which an asset would be sold or the price paid to transfer liability, observable data from active market should be used wherever possible. Wherever possible. What is your first source where you are looking for to find the price? Observable data from active market, the markets which are very active, where you, for example, the market. Okay, let's say you have a product which has a very active market. Okay, the product is very common. It's openly bought and sold. It's very easy for you to find that price because it is number one active market, number two observe. You can observe the data. You can observable data from active market. So wherever this situation comes, first instance is Wherever possible, try to use this to the maximum, because that gives you a more fair, a better picture, no? Compared to the ones where you are not able to observe the information or where the markets are not active. Okay. An active market. What does an active market means? Very frequently, there's a transaction for the asset or the liability. Okay. The market is big. The commodity is bought and sold very frequently in a large quantity. That is known as active market. IFRS 13 classifies this, all the three levels you need to memorize. You need to know, understand, of course, and then you need to know it. Okay. So, okay, from level 1 to 3, you need to know. IFRS 13 classifies inputs into valuation techniques into three levels. For when you are valuing a fair value, or for valuation techniques, three levels are there. Okay. Level 1, level 2, level 3. What is level 1? Inputs are quoted price from identical assets in active market. First of all, what is the fair value? That fair value is what is quoted price. Okay, the prices are quoted for some identical assets. Identical assets means same asset. For example, if I want to know the price of my calculator, or let's say my mobile phone, the model which I have, if I want to know the price, what would I do? I would go to the market and see what is the price of the similar phone that I have, right? And I know that that is the more accurate fair value, because market is active. The mobile phones are bought and sold in huge quantity very frequently, and identical, it's very identical to my phone, my model. Okay. And the prices are quoted, you can see. Okay. So that is level 1. Whenever you have to value, you first go through level 1, then level 2, then level 3 is the last resort. It goes in this order. First you see identical assets, whether there are identical assets for that or not in the active market, if you want to value your asset or liability. If it's not available, then you go to level 2. Level 2 is, here inputs are observable prices, not quoted. Remember, here if you see level 1, here if you see, okay, in level 1, the input, they are quoted prices. Okay, but whereas here it is observable prices, not quoted prices in level 2. Okay, the inputs are quoted prices that are not level 1 input, that are not level 1 input. It should not be in the level 1. If something is in level 1, then it does not come in level 2. This may include, what does it include? Okay, quoted prices for similar assets in active market. See the word, it's not identical assets here, it is similar asset. Okay, in active market. Okay, quoted prices for identical assets. Okay, same like for level 1, but here it is in less active market. If it's for identical assets but in less active market, or similar assets in active market, or observable inputs, or both this for quoted prices, this is observable inputs you observe, that are not prices, such as interest rate. Okay, for example, if it's a liability, you can observe the interest rate. Okay, level 3, inputs are unobservable, you cannot observe. Example, this include cash or profit focus using an entity's own data. When you're using your own data, can you observe? No, you cannot. For example, cash or profit focused, if you are focusing based on your cash or profit, it is something unique to you. It's not there in the open market, so you cannot observe it. That should be your last resort. Okay, level 3. So a significant adjustments to a level 2 input would lead to it being categorized as a level 3 input. That, what does it mean? If you have to make so much of adjustments in level 2, significant adjustment, not minor adjustment, significant, then that level 2 comes to level 3, falls down to level 3. It is categorized as level 3 then. Okay, so what the, okay, this is the main thing. Right, your priority should be given to level 1 input first. Okay, in order to calculate fair value, the lowest is level 3. For example, you want to value an item, you want to find the fair value of an item. Let's say you're not finding an active market for it, then you go to level 2. Level 2, you see whether there are less active market but identical asset. If that is also not possible, Okay, or similar asset is also not possible, then you go to level 3, where you measure the fair value based on your own cash or profit forecast. Okay, but that should be the last one if you're not having any active market or identical assets or similar assets like that. Inputs to determine fair value. There, okay. So let's see. Here they have given you the 3 examples for 3 different levels. Level 1, equity shares in a listed entity. Because it is listed, it is quoted. Okay, you can use quoted prices. You can observe it, and there is an active market. It satisfies all the 3 conditions. This is an example. Okay, so unadjusted quoted prices in an active market. You don't have to adjust the price. Same price you can use as it is, which is quoted, and there's an active market. That is an example of level 1. Level 2, building used and held and used. Example. Okay, so for level 2, this is the asset, and what is an example? How can you use it? Price per square meter for the building from observable market data. You see, if you want to get the price per square meter, you observe the market data, isn't it? Such as observe transactions for similar buildings in similar locations. So you will see how other buildings in the similar locations are sold at, what is their price, and then you get a price for your building. Third is cash generating unit. Okay, profit or cash flow focus using own data. You are using your own cash flow forecast. Neither you can observe it, neither there's an active market for it. So it's level 3. Okay, now test your understanding I will be doing in the next. There's a series on test your understanding. They'll be solving test your understanding. Okay, market. Now 2 things you need to understand. One is known as principal market, one is known as most advantageous market. Okay, under fair value. What is this? We'll go through it. Okay, we'll go through it now. So the fair value, the price received when an asset is sold may differ depending on the specific market where the condition occurs. This is the same definition for fair value only. Okay, that means fair value may differ depending on the specific market where the transaction occurs. It depends on which market the transactions are occurring. The fair value will change. Is it the principal market or the most advantageous market? What is principal market? Make sure that you know this 2 market, the definitions, and okay, the definition of this 2, because you need this 2 to value fair value, to calculate fair value. We'll do a calculation also shortly. IFRS 13 says fair value should be measured by reference to principal market. How do you measure fair value? You reference it to the principal market. What is the principal market? What is principal market? This is the definition of the principal market. It is the market with the greatest activity for the asset or liability being measured. Greatest activity. Huge volume transactions are occurred in this market. The asset entity must be able to access the principal market at the measurement date. Okay, you should be able to access that principal market, but at the measurement date, whenever you are measuring it, the fair value. This means that the principal market for the same asset can differ between entities, right? What does it mean? For the same asset, the principal market might be different from entity to entity. Not every entity will have the same principal market for the same asset, because they might not have access to that principal market at the measurement date, right? Now we are going to the most advantageous market. If there is no principal market, okay, then we go to the most advantageous market. But first choice is principal market. If that is not available, then fair value is measured by reference to prices in the most advantageous market. This is the definition, and make sure you learn this definition. Most advantageous market is one that maximizes the net amount received from selling an asset or minimizes the amount paid to transfer liability. That means when you're selling an asset, you should get the maximum amount. Wherever you get the maximum amount, that is known as most advantageous market. Advantages, it should be advantage to you. Okay, so the word itself says the definition. Transaction cost. You need to know the transaction cost also. What is transaction cost? It is legal and broker fees. Definitely there will be some legal cost and also broker fee you might have to give to the agent or not. Okay, will play a role in deciding which market is most advantageous. However, fair value is not adjusted for transaction costs because they are characteristic of the market. Okay, you don't adjust the transaction cost when you're calculating fair value. Why? Because they are the characteristics of the market rather than the asset. Because transaction costs are not the characteristics of an asset that you need to change. It is the characteristics of the market. So you don't adjust it. Test your understanding 4. Okay. Definitely we need to do this one so that you understand how do you measure fair value and what is the principal market and what is the advantageous market. Okay, and asset is sold in two different active markets at different prices. An entity enters into transactions in both market and can access the price in those markets for the asset. The measurement is as follows: market 1 and market 2. What is the fair value of the asset if market 1 is the principal market for the asset and no principal market can be determined for part B? Okay, so before we go to the non-financial asset, we need to solve that. Test your understanding 4. So test your understanding 4. If you see, I will just take a picture of the question because make sure that you also take it so that I don't have to scroll up to see the question. Okay. Okay. Now let me go to the answer. So for part A, principal market is market 1 is the principal market for the asset. Okay. So price was 26 under market 1. Transaction cost was 3. Transport cost was 2. Net price received was 21. So if market 1 is the principal market, then the fair value would be measured using the price that would be received in that market less the transport cost. The fair value would therefore be 26 minus 2. We are not taking transaction cost, okay, because we told that transaction costs are ignored as they are not characteristics of the asset. We are not adjusting transaction cost when we calculate fair value. We are only deducting the transport cost from the price. Price is 26, transport cost is 2, 26 minus 2, hence fair value is 24. Okay, I hope this clears your doubt. When you're using principal market, what is your fair value? Next, we are going when there's no principal market, then we refer to most advantageous market. Okay, so if neither market is the principal market for an asset, then a fair value would be measured in most advantageous market. The most advantageous market is the market that maximizes the net amount received from the sale. So net amount received in market 2 is how much? And you need to see what is the net amount received in market 1 and compare. Whichever is higher is the advantageous market. So net amount received in market 2 is 22, is higher than the net amount received in market 1, which is 21. Okay, it's already given to you the net amount received in your equation. So therefore, market 2 is the most advantageous market because it is giving you the higher net amount received. This results in a fair value measurement of 23. How 23 is the fair value measurement? Because now we have decided based on net amount received, the advantageous market is market 2. So now we take price minus transport cost, which is 25 minus 2. Remember, we are not adjusting the transaction cost. Okay, so 25 minus 2, 23 is the fair value. 21 and 22 are not the fair value. Okay, 22 is not the fair value. This we are seeing whichever is higher for us to decide the advantageous market. Once we have decided that the advantageous market is market 2, then the same procedure applies. Price minus the cost. That is the fair value. Hence, 23 is the fair value. Okay. IFRS 13 specifies that transaction cost plays a role when determining which market is most advantageous. But they are not factored into the fair value measurement itself. Right? Definitely. When you're determining advantageous market, transaction cost does play because we took the net amount received, net price received based on what? After deducting transaction cost only, no? That 22 or 21. So there we are taking the transaction cost. Their transaction cost plays a role when you are determining the most advantageous market, but not when you are taking the fair value measurement. Okay. So test your understanding 3. Okay, maybe we can do test your understanding 3 also at the end of this video. Since that's a small thing. Okay, now where were we? Now we are moving on towards non-financial asset. Okay, this part also you need to remember because most of your IFRS 13 comes from this area, non-financial asset. You need to know what are non-financial, what are financial asset. The way you calculate fair value differs if it's financial versus non-financial. Look, what is a non-financial asset? Difference between financial and non-financial asset is covered in detail in chapter 12. Financial asset includes, okay, this financial asset, you will get it from your IFRS 9 financial instruments, okay, there the definition is given, but here you can see some examples of it briefly. One is contractual rights to receive cash, such as receivable. Receivable is one of the financial asset. Why? It's because you have the right to receive cash from your customer, isn't it? Contractual right is there. So receivable is a financial asset because it is something relating to cash or money or currency. It is financial. Okay, it is asset but financial asset. Investments in equity shares is also financial asset because you are going to receive money from it. Cash, you are going to receive cash, right? So once you invest in equity shares, you are going to get cash. So it's financial asset. Next, what are the non-financial? Remember, you need to know these examples because in the exam they will not tell you financial or non-financial. They will just give you property, plant and equipment or investment in equity shares. That time you should be able to categorize it into their category and then do the calculate the fair value. So property, plant and equipment, okay, it's non-financial. It's an asset, non-current asset, but it's non-financial. And other one is intangible asset because we don't have any contractual right to receive cash from holding by this too. Okay, so therefore these are non-financial, even intangible asset. Now fair value of a non-financial asset. Okay, so how do you calculate fair value of non-financial asset? That means intangible assets or property, plant and equipment. IFRS 13 says that fair value of a non-financial asset should be based on its highest and best use. Remember this word. When you're taking the fair value of non-financial asset, for example, property, plant and equipment or intangible asset, or it could be a brand or anything, then highest and best use. What is highest and best use? You need to memorize these terms. Highest and best use of an asset is the use of a market participant would adopt in order to maximize its value. That means market participant would adopt in order to maximize its value. For example, you might have, you can use the asset in one of the two ways. Okay, so you have to see which of the two will maximize your value. Okay, whichever maximizes your value, you have to, that is known as highest and best use of an asset. For example, a building, you can run it as a commercial building or a residential building. Now you have to decide, you will see which one will give you more value by having a residential or a commercial. Okay, if it's residential, then residential is the highest and the best use of an asset. Okay, we'll definitely do questions on each, so you don't have to worry about it if you're not understanding the theory also behind it, the logic behind it, but you will understand when once we do the questions. The current use of a non-financial asset can be assumed to be the highest and the best use. What is it? The current use. That means what is the current use of that asset? In whatever use it is, if it's non-financial asset, that is assumed to be the highest and the best use. Unless there are evidences that that is not the best use. Okay, evidence exists to the contrary. This also you need to remember. Highest and the best use should take into account uses that are, you have to take three things. You have to see, is it physically possible? Is it legally permissible? Is it financially feasible? Okay, remember these three words. When you want to go for the highest and the best use, you have to see whether your highest and best use, is it physically possible, legally permissible, financially feasible. You have to think in terms of physical, legal and finance. Okay, IFRS 13 says a use can be legally permissible even if it is not legally approved. It is permissible even though it's not legally approved. Okay, now test your understanding 5. Okay, we need to go through this and let us go through the investor's perspective. Below is an extract from the disclosure note about the fair value of an entity's financial assets and liabilities. Fair value of financial instruments. Okay, financial asset, financial liability. Level 1 and level 3. Okay, so we are almost done. Uh, Fair value of the traded equities have been determined by the reference to the market price quotation. That's why it's in level 1. We used market price quotations, quoted prices. Fair value of contingent consideration is estimated based on the forecast future performance of the acquired business over a time frame determined as part of the acquisition agreement. Discounted as appropriate. Key assumption. Definitely, it used forecast, right? Future performance, forecast of the future performance. That's why it's in level 3. We just went through the 3 levels. Key assumptions include, what are the key assumptions? Growth rate, expected selling volume, prices, direct cost during the period. This disclosure informs investors. Okay, this is given as a note. Okay, how did you determine the fair value of this? How did you determine the fair value of this? See how they are writing it in notes. Paragraph 1 for level 1, paragraph 2 for level 3, paragraph 3. This disclosure informs investors that the fair value of investments in entities have been derived using level 1 input. Quoted prices for identical assets in the active market. This measurement requires no judgment. No judgment is there because there's no risk in this. It is identical quoted prices for identical assets in active market. Okay, eliminating the risk of bias. There you cannot be biased that this is the fair value they should be. That risk is eliminated. It's like it is verified. Okay, and it can be verified by knowledgeable third parties, the one who has the knowledge of the price. Next, in contrast, disclosure informs investors that the fair value of the contingent liability has been derived using level 3 input. Remember, level 3 input is not a good thing. It's more risky when you are finding fair value using level 3 input. This measurement therefore involves a high level of judgment. You used a lot of judgment there to evaluate, increasing the risk of management bias. Management could be biased, okay? There is also a risk that the amount the entity eventually pays will differ materially from the year-end carrying amount. Yes, it can happen. Amounts can differ materially. For this reason, the disclosure provides additional information about how management have estimated the fair value of the liability. See, additional disclosures required wherever you have used more judgment, wherever there's a risk of bias from the management's point of view. There you need to disclose more in how did you estimate the fair value of the liability, so that the investors can assess the adequacy of the methodology used and reach a conclusion as to whether the level of measurement uncertainty is acceptable to them or not. They want to see whether they can accept the uncertainty or not, the measurement uncertainty. So due to the level of the risk, some investors may decide to sell their shares in an entity in its fair value measurement are overly reliant on level 3 inputs. Okay, because if we know that level 3 is risk, what do the investors do? They sell their shares. Okay, they sell their shares if they know that their fair value measurements are, they are relying too much on level 3 input only. No level 1, no level 2. Level 3 is very risky. It's your own forecast. You don't have any market information. You don't have any active market. Okay, so we have some test to understanding. So before test to understanding, let me summarize this. This is the chapter summary, and this chapter, this IFRS 13 was given in chapter 1 of your textbook. If you go through your textbook, IFRS 13 comes in chapter 1 along with your conceptual framework, right? After your conceptual framework, IFRS 13 begins. That's why if you see the chapter summary, they're talking about conceptual framework and all those things. We have covered all those things when I've discussed conceptual frameworks. I'm not wasting my time going through that again. What I am focused is on the fair value part. Okay, so this everything is summarized here. We discussed the market principle and most advantageous market, how to find out to value the fair value. How are you going to measure fair value? Based on market cost and income. Okay, and what is the definition of fair value? Exit price in orderly transaction between market participants. Market participants means buyer and seller. Okay, so how do you, when you measure using market, whether market cost or income, you prioritize level 1 input. Okay, so that's it. We have finished. So now we are going to cover test understanding, right? We have finished test understanding 4. We have test understanding 3, I think. Yeah, oh, starting from 3. Discuss whether the valuation technique suggested by the directors complies with IFRS. Baklava has an investment property that is measured at fair value. This property is rented out on short-term leases. The writers wish to fair value the property by estimating the present value of the net cash flows that the property will generate for Baklava. How are they measuring the fair value? By the present value of the net cash flow. They argue that this best reflects the way in which the building will generate economic benefits of Baklava. They think that this is the best way. The building is unique. See the information. The building is unique also. Although there have been many sales of similar buildings in the local area. Okay. Now let us go to the answer. Test understanding 3. Test understanding 1 and 2 are related to your conceptual framework. Okay. So director's estimate of future net cash flows of the building will generate is at level 3 input. Okay. Whenever you're estimating something based on cash flows or profit, that is level 3 input. Remember it. IFRS 13 gives the lowest priority to level 3. Right. IFRS 13 does not give so much of importance to level 3. That is like the lowest. This should not be used if level 1 or 2 input exist. If you have the information relating to level of 1 or 2, you can use level 1 or 2. Then you should not use level 3. That's what the standard says. Observable data about the recent sale price of similar properties is level 2 input. You see, even though you don't have the identical but similar building has been used in that local area. So you can use level 2 input rather than level 3. Okay. So the fair value of the building should therefore be based on these prices, with adjustments made as necessary to reflect the specific location and condition of Baklava's building. Definitely, even if the price you have taken from the similar building in that location, you need to adjust it because there are conditions which are unique to Baklava. Okay, so that price reflects the condition and the location of the Baklava's building. Okay, that is how you measure the fair value. Now let us go to test understanding 5 and 6. Test understanding 5 was about 5 quarters. How should the fair value of the land be determined? Land is what? Land is a non-financial asset. 5 quarter has purchased 100% of the ordinary shares of the 3 halves and is trying to determine the fair value of the net assets at the acquisition date. 3 halves owns land that is currently developed for industrial use. What is the use? Industrial use. They will always give you the use, okay? Most of the time it has been land. Residential use versus industrial use. This is one of the common question which has been asked for you to determine fair value, so you can use this example. The fair value of the land if used in a manufacturing operation is 5 million. Many nearby plots of land have been developed for residential use as high-rise apartment buildings. If you see the nearby land, it is used for what purpose? Residential use. As high-rise apartment buildings, the land owned by 3 halves does not have planning permission for residential use. Do they have planning permission? They do not have planning permission. That means legally not permissible. Although permission has been granted for similar plots of land, right? It is likely that permission will be given. Why? Because in the similar plot of land, permission is given but not yet given. Fair value of this one, 3 halves land as a vaccine sign for residential property is 6 million. Okay. And transformation cost is 0.3 would need to be incurred to get the land into this condition. So it is not in the condition also available. It is not physically possible also. Okay. So it looks like that the fair value should be 5 million rather than 6 million, but we'll see the answer for. Okay, this is test understanding 5. First of all, whenever such question comes, even in the exam also, okay, always start by defining whether it's a financial asset or a non-financial asset. Land is a non-financial asset. So IFRS 13 says that it's the highest and best used, okay? Fair value of a non-financial asset should be based on its highest and best use. This is presumed to be its current use, right? So that highest and best use is also, we assume, that is the current use only. Unless there are evidence that that is not the highest and the best use. What is the current use of the asset? According to the current use of the asset, fair value will be 5 million because industrial use. Okay, there's evidence that market participants would be interested in developing the land for residential use. There are evidences. What is it? Residential use of the land is not legally prohibited. Okay, they didn't prohibit legally. They cannot say, oh, no, you cannot use it for residential purposes, the land. They did not prohibit like that. Because similar plot of land has been given the permission. So there are chances that even they also will be given the permission. Okay, so if it is used for the residential purpose, what is the fair value? It is 6 minus the transformation cost, which is 5.7. So it would seem that the land's highest and the best use is for the residential development. Its fair value is therefore 5.7 million. Okay, so that means I was wrong before, right? 5.7 is the highest and the best use. Now let us go to last test understanding 6. IFRS 13 and conceptual framework, they are linking the two. Conceptual framework says that the purpose of the financial reporting is to provide useful information, financial information users of financial statements. Discuss how the application of IFRS 13 enhances the usefulness of financial information. Your answer should refer to the qualitative characteristics of the useful financial information. When I did conceptual framework, that was my first lecture, I explained to you what are the qualitative characteristics of useful financial information. So I'm not repeating it, I'm assuming that you know it. Okay, now let us solve test understanding 6. So it's plenty big enough. Okay, 2 fundamental qualitative characteristics, 6 enhancing qualitative characteristics. Sorry, 4 enhancing qualitative characteristics. Total 6 characteristics are there for the useful financial information. That's what the answer has written. To be useful, the financial information must be relevant. Relevant is the word, and provide a faithful representation. This is the second one. Of the transaction that the entity has entered into. A complete faithful representation is complete, neutral, and free from error. That's what faithful representation means. Okay, this 3 thing has to be there. Measuring the items at fair value is often argued to provide relevant information to an entity stakeholder. It is argued to provide relevant information. However, IFRS 13 does not specify when assets or liabilities should be measured at fair value. This is governed by other IFRS and IAS standards. You see, IFRS does not say when asset or liability should be measured at fair value. That is decided by other standards. Next. When measuring fair value, okay, IFRS 13 requires entities to use level 1 input when available. Quoted prices for identical assets in active markets. These inputs require no judgment, and so the resulting measurement should be neutral, isn't it? The prioritization of observable inputs in IFRS 13, both level 1 and 2, means that the resulting valuations are verifiable. You can verify it, the valuations. IFRS 13 enhances comparability between entities, right? For example, management estimates level 3 inputs. They estimate. Level 3, you use a lot of estimates. Okay? IFRS 3 enhances comparability. Because of IFRS 13, you can compare between the entities. Okay? So, for example, they estimate level 3 inputs should only be used if no other inputs are available. Similarly, IFRS 13 requires entities to measure fair value from the perspective of a market participant rather than an individual entity, which will aid investors when comparing one entity with another. Because of this, because it's from the market's participant's perspective, not entity, what happens? This will make the investor to compare. They can compare entity to entity. It will help them. So requirements to measure fair value using the principal market and to base the fair value of non-financial asset using the highest and the best use reduce the scope for management buyers. You see, they have clearly mentioned. So that means no matter what organization you are in, any organization, if it is non-financial asset, fair value they will measure based on highest and best use. If it is principal market, then fair value they will measure, then they will measure fair value using principal market. Okay, so because of this, management bias reduces. Okay, and ensure that entities are determining fair value consistently. Okay, measuring fair value consistently, you're determining fair value. It's not just that once you measured fair value and later on you're forgetting you're not measuring at fair value. No, every year once you start using fair value, every year you have to remeasure it, calculate fair value, because every year it changes. Now, requirements to disclose estimation methods when a fair value is determined using level 3 inputs help ensure that financial statements are understandable. Okay, so whenever estimation you are using in level 3 inputs, what does requirement says? IFRS 13 says disclose it. Disclose. So because of that disclose, what happens? It ensures that financial statement is understandable. That means the user who is using it, who is reading the financial statement, they can understand how you got it, how that fair value is calculated when you disclose it, that you have estimated using level 3 inputs. Okay, so that's it. I thought of doing the previous two standards also. Sorry, test understanding 2 and 1, but since like the answer is then big enough, so maybe we'll do it in another video. Okay, so that's it for IFRS 13 fair value measurement, and I hope that after this, now when you go and try to do questions under other standards, whether IS 16, IS 38, IS 40, you will be able to understand. Wherever the fair value question comes, you'll be able to understand it better and apply the knowledge of IFRS 13 there. Okay, so till then, take care and see you in the next standard.